Good. So now, if you look at this particular topic under margin and absorption costing, it is the simplest topic of all because you only need to understand how you are going to deal with one particular item. That is fixed production overheads. Once you've been able to understand how you're going to treat these fixed production overheads, then automatically you are done with this particular topic. Because the examiner will be asking you very simple questions. One, can you give us the arguments against marginal and absorption costing? Give us the arguments against. Give us the arguments that are supporting this. That is arguments for marginal and absorption costing. Give us the applications, some of the applications of marginal and absorption costing. That's number two. Number three, if you now go to the calculation part, having done the theory for this particular topic or margin and absorption costing, are you able to give us the income statement? Are you able to give us the income statement with respect to marginal costing? Marginal costing, income statement. Are you able to give us absorption costing, income statement? Are you able to give us the two? And of course, due to the difference in method or the procedure of getting the net profit, this one here will bring a very huge difference or effect to the net profit of marginal costing and also the net profit of absorption costing. How we are going to deal with this one here in these two methods will determine the amount of net profit that you're going to get as per this, and also the net profit you're going to get as per absorption costing. And therefore, because the profits are going to be different, yet the same data set is what you're going to use, you must be able now to go ahead and give us reconciliation statement that is going to help you to reconcile the different profits as per marginal and the profits as per absorption costing. So you must be able to come up with the reconciliation statement. You must be able to prepare the income statement as per absorption and marginal costing. Then in the process of preparing the statements, we are going to meet these terms: absorbed, the overheads. You are going to absorbed overheads. There are those overheads. Under absorbed overheads, you're going to meet under absorption or over absorption. You're going to meet the different values of the closing inventory. For example, under this, you're going to find that the closing inventory in terms of units will be 150. But now the value of the closing inventory will be different for each method. And therefore, for the closing inventory, during reconciliation, you are also going to meet these terms of understated, stroke overstated, stroke overstated, one, closing inventory, and then opening inventory. We all know that the closing inventory of the previous period is the opening inventory of the current period. So in short, if you're going to deal with the two different periods, let's say the month of January, month of February, when you have opening inventory here, you will have it, then closing inventory. So if the closing inventory in the month of January happens to be 80, it will be the opening inventory in the month of February. So we have closing inventory affecting the transactions in January as a closing inventory. We have the same closing inventory going to affect transactions in the month of February as an opening inventory. And therefore, the effect of these two items, even though it might be looking like the same thing, but how we use it here, we call it closing inventory. When we now move to the next or the subsequent period, we call it opening inventory, and they have different effects on the cost of sales. So because they have different effects on cost of sales, we are automatically going to see their effect on our net profit at the end of the day. Again, this one here, or this concept, is an extension of the last part of topic number 4, which we covered, where we're dealing with over stroke under absorption. That concept has been transferred to this particular topic, but then you're going to look at it when we are dealing with the fixed production overheads. Under reconciliation, we must know the overstated or understated value of the closing and opening inventory. That is what we basically need to understand here. So let's get to our LMS where we have the notes from this particular topic. Then we should be able to see what is going on there. What do we need to know in terms of theory? What do we need to know in terms of theory? So let's get to the platform. Let's get to the platform. I've logged into the platform. So let me get to my courses. Let me get to my courses under management accounting. We need to move direct to topic number 5, number 7, topic number 7. And the first part of topic number 7 is the differences between marginal. So marginal and absorption costing are two different approaches to dealing with fixed production overheads, and whether or not they are included in valuation or valuing inventory. So the reason why they are going to have different prices is basically due to the effect of how we use the fixed production overheads in our transactions. Now, if you look at these, the distinction, the difference between the two, one, if you're going to compare them based on meaning, a decision, so marginal costing, a decision-making technique for ascertaining the total cost of production, then absorption costing, apportionment of total cost to the cost center in order to determine the total cost of production. Now, this is what we need to understand. This is what we need to understand. If you look at marginal and absorption costing, I think just some minutes ago in your WhatsApp group, I indicated that we are going to do topic number 7, and I mentioned variable costing and full costing. When we arrive in class now, we are talking about marginal and absorption. When you're going to do your cut or mock, you'll be finding that I'm going to indicate direct, then indirect. So the examiner can use any of these three to refer to marginal costing. The examiner can use any of these three to refer to absorption costing. How do we get the cost of the products under marginal? Marginal costing, remember what we said the other day, that for us to get the cost of a given product, we are going to have direct material. We need direct labor plus any other direct cost for us to arrive at what we call prime cost. When we add, now as per this particular method, marginal costing, remember here we are adding production overheads. If you can remember what we covered the other day, we are adding production overheads. Here, we now have to identify or classify the production overheads into two. Remember, we have the variable production overheads, and then we have the fixed production overheads. As per marginal costing system, it is only variable production overheads that forms part of the product cost. And therefore, if you now get to this part, we have to be specific. We have to indicate variable production overheads so that we get product cost. When we come to absorption, full costing or indirect method, here we have to get to the prime cost, so direct material, direct labor, then we have our prime cost. Then we have to add variable production overheads. Then we have to add fixed production overheads. When you add these, you are getting product cost or production cost. That is the difference between these two methods. That is the difference between these two methods. Now, from whatever you've just seen, from the formula that you've just seen, you'll be able to see under full costing method, we are including the fixed cost to be part of the product cost. So automatically, this cost will be higher than this one here. When the production cost is higher on the full costing method as compared to this side, you'll be able to see that net profit here will be higher as compared to the net profit this other side. So we expect that, remember, you're going to use the same data. If production is 7,000 units in the month of January, it is the same across. But at the end of it, you're getting the profits to be different. So you have to reconcile the profit so that the profit here is equivalent to the profit on the other side. That is what we have. That is the structural definition or classification of what we are going to discuss. So now look at what we are being told here. Look at what we are being told here. So cost recognition, the variable cost is considered as product cost, while fixed cost is considered as period costs. Both fixed cost and variable cost is considered as production cost. But remember, it is not just any other fixed cost. It is fixed production costs, fixed production overheads. Classification of overheads, we have fixed and variable, while absorption, we have production, administration, selling, and distribution. That is under absorption costing, we only know production costs and non-production costs, where the non-production costs are classified into administrative. Then we have selling and distribution costs. Profitability. Profitability is measured by profit volume ratio due to then this other side, due to the inclusion of fixed cost, profitability gets affected. Profitability gets affected. So that is, under marginal costing, the profitability is constant. The profitability or the profit, the way of getting the profit is constant, and the only way, the simplest way to recognize your profit will be basically dependent on volume. Volume of output. Volume of output. If you are keen enough with what we've been discussing in the previous period, it is only volume of output that's going to affect this particular results. So it means this one here is taking you to already applications of topic number 7, or basically marginal costing. Initially, the topic of marginal costing was combining limiting factor, was combining break-even point analysis. So that is, if you are now able to understand just marginal costing itself, it means if we get to topic number 8, where we are going to discuss break-even point analysis, you will be good to go. Because under break-even point analysis, you're going to find that one of the assumptions is that the volume or the profit of a company or sales are dependent on the volume. As the volume increases, the profit increases. And that's why you normally find that in topic number 8, under break-even point analysis, we also just deal with the 2 types of costs. It is either variable or fixed. So the variable costs will be grouped together for you to come up with the break-even point function. This one here, that is the break-even point. So as you can see, it is selling price minus variable cost or the contribution margin. So the changes in this is basically dependent on the Q or quantity of output. That is what you are going to cover. So basically, if you are asked to give maybe 3 or 2 applications of marginal costing, number 1 is used in break-even point analysis to identify the break-even point at which the company will not be making losses or profits. Another application, there are these things that the company is trying to produce. So 1, they are producing 3 products, C, X, Z. But out of these 3, this one here, they are making, if you look at the net profit, this one here is a negative. So they want to come up with a decision, or they want to do investigation to determine whether they can eliminate this product. That decision is arrived at by applying the marginal costing concept. You look at the variable components, which automatically will be depending on the units of output. Having done that, how will elimination of this product affect the distribution of fixed cost, which is shared by the 3 products? That's an application of marginal costing. There's this company that also has a decision whether they are not able to determine whether to buy / make. They are stuck in between buying or making. So of course, if they're going to buy, they're going to outsource. If you're going to outsource these goods, there are some costs that you cannot avoid. 1, if you decide to buy, you're going to incur the transportation cost. You bring them to warehouse. So the storage cost within the warehouse, you have to pay that. Whether you are going to make your own product or you are going to outsource. So in making this decision, they have to determine how much are they paying for the storage? How much are they paying for the warehouse? If they eliminate one product and they decided to buy it, will it help them reduce the effect of the fixed cost to other products? If they decide to manufacture it, will it be economical to manufacture that particular product taking in mind the quantity or the level of demand of that particular product. That's another extension or application of marginal costing. The limiting factor effect, the limiting factor effect. A company is producing these three products, but raw materials Z, or let's say Q, is being used to produce the three products. And in one particular year, the company is only able to do what? The company is only able to purchase 4 million units of this raw material Q. How will they ration the available units of material Q to produce C, X, and Z such that they are able to meet the market demand, and at the same time, they maximize their returns or their net profit from that particular raw material Q? That particular knowledge must just be understood by, first of all, ensuring that you understand what marginal costing entails. Are we together? Are we getting sense? Are we really getting something from that? Are we getting something from that? Are we getting something from that? Okay, then you now come to this part here, cost per unit. Here, stock does not influence the cost per unit of output, that is marginal. Then here, variances in the opening and closing stock affects the cost per unit. The variances here in the opening and closing stock occurs due to the differences in the absorption rate. We have over and under absorption. Then highlights contribution per unit. We are going to deal with the contribution per unit here, that is gross and net, while absorption costing, we are going to deal with unadjusted profit, and then finally look at the adjusted profit. So valuation of products under marginal and absorption costing. And under marginal, of course, I've just mentioned it here. We have direct material, direct labor, then variable production overheads. Under absorption costing, we have direct material, direct labor to give us prime cost. Then we add variable production overheads and fixed production overheads. So the two forms part of the product cost under absorption. Comparative income statements. Under marginal, this is what we are going to have. You need to have sales. Then when you're going to less the cost of sales, we have opening stock, add production cost, where the production cost consists of material, direct labor, and variable production overhead. So having added the two, you multiply by the units that were produced. Then you're going to get what we call gross contribution. We less other variable costs. When you less other variable cost or non-production variable cost, you'll arrive at what you call net contribution. Once you get your net contribution, the first thing you less fixed production costs, then fixed non-production cost for you to be able to arrive at your net profit. How about absorption? The sales value will be the same, less cost of sales, where we have opening stock, add production cost, which now entails direct material, direct labor, production overheads, that is variable and fixed. Then we less closing stock for us to get gross profit. But the gross profit you are getting here, first of all, you get the unadjusted. You adjust it by looking at over or under absorption of overheads. Then you get to the deduction of the fixed non-production costs. And of course, you have an illustration here, which we are not going to tackle because some will not be able to get it. I want us to pick a question from the past papers. But you can attempt this. You try doing this, you discuss it amongst yourselves. If not, it might find itself in your CAT or mock. That is for the ATD students and even the CPA. Having done that, it is taking you basically to the arguments. So arguments for the use of marginal costing. Arguments for the use of marginal costing is basically advantages. So how is using marginal costing advantageous or beneficial to an organization? So one, you can see it helps in decision making. That is, marginal costing is useful in short-term decision making, such as price determination. We've seen it here. We've clearly seen it here when we were saying the applications. Those applications are now some of the benefits or arguments for. So we've seen if you want to do production of a given product, it enables you to determine the quantity you are going to produce. And in the process, by predetermining the price, you can be able to make the decision on what profit margin or markup to set for your goods. Number two, under break-even point application, we are able to see it automatically enables you to know, one, the units you are supposed to produce for you not to make any loss. That's number one. Within the same place, remember, under break-even point, you can have a target profit. If you have a target profit, how can you use the target profit to work backwards to know the exact units you are supposed to produce? Still an application of marginal costing. Still an application, and that's one of the arguments for marginal costing. Then number three, we've been able to see you have to make a decision here whether to buy or produce. Whether the quantity you are supposed to produce, even what you're supposed to purchase. The limiting factor. You have limited resources. How will you distribute it? How will you distribute the limited resources? Again, an application of marginal costing. And that one automatically confirms that the arguments, or it gives us the points to indicate under arguments for marginal costing. Let's see another one here. Then we have easy to understand. Marginal costing is simple and easy to understand. Of course, we've been able to see that. The only thing you need to know is to identify the variable production costs. Then now arguments against or some of the limitations in accurate profit calculation. Why? Marginal costing does not take into account fixed overhead costs. As a result, it may provide an inaccurate picture of the profitability of a product or service. Then, inadequate for long-term decision-making, marginal costing focuses primarily on short-term decision-making and may not provide a comprehensive view of the long-term profitability of a product or project. Undermines cost control. Marginal costing does not emphasize cost control or cost reduction efforts. You are trying to minimize cost, but so long as you have the variable production cost, it considers only volume. It is only concentrating on the volume of output. It does not work towards minimizing the existing variable costs. Then distorted inventory valuation, which we are going to see after doing an illustration. Ignoring capacity utilization. It does not consider whether the company has got excess capacity which can be used in other activities. It is basically considering that basic or. So here they are trying to explain that marginal costing assumes that fixed costs remain constant within a certain production capacity. However, in reality, as production levels changes, fixed cost may also vary. Ignoring capacity utilization can lead to suboptimal decision regarding pricing, production levels, and resource allocation. How do we really look at this? How do we really look at this? For example, one, the company, so the fixed production overheads, we have 4,000. We have 4,000 units produced. We have 100. So you can see, if the company is going to produce only 100 units, then the fixed production overheads per unit will be, the fixed production overhead per unit will be 4,000 divided by 100, which is 40. When these units are now increased by just one, that is 101, what will be the new fixed production overhead per unit? We are going to have 4,000 still, but now you divide by 101. What will we have? What will we have there? What will we have there? Somebody? 4,000 divided by 101. 39.6. It has now reduced from 40 shillings to 39.6. Let's say the company has tried so hard to increase this to 105 units. They have increased the quantity to 105 units. What will be the new fixed cost per unit? The fixed production overhead per unit. What will we have? 38.1. So you can see, as the quantity increases, the fixed production overhead per unit is reducing. The company is able to recover the fixed production overheads that were incurred. So this one here, imagine under marginal costing, it says that the fixed overheads are constant. It does not change. Even if you produce 500 units, it will still be this one here. But now, under absorption costing, you'll be able to see that the fixed production overheads must be used in consideration of what was actually produced. You give us the standard, yes, but we compare the actual overhead as per your standard. Then we now look at over or under absorption. That is what we need to understand here. So as the quantity increases, from 100 to 105, the fixed production overhead per unit is reducing. And the reduction in that is basically beneficial to the company because it is helping them to increase their final profit. Then if you move forward, so those are some of the arguments for and against marginal. Then we have arguments for the use of absorption costing. One, conforms to generally accepted accounting principles. Then useful for long-term planning. Then number 3, useful for inventory valuation, useful for setting prices. Automatically, it confirms to us that currently those companies that are reporting their performance, the financial statements, those companies that are publishing their financial statements, a manufacturing company or a company that's offering service and they are doing costing, they don't use marginal. Marginal costing system is used by basically management. It is being used when preparing management report. But we are going to prepare published financial statements. You basically use full or indirect or absorption costing. That's what you use to report your financial or to publish the financial statements. If you're going to do valuation of inventory, the correct one that is normally being used when publishing financial statements is the full costing method, not marginal. Marginal is basically used for internal consumption by the company. The marginal method is basically used by consumption by the internal management of an organization. So that is what we have there as arguments for. Then if you move further to this part here, so the reconciliation, of course, you're going to look at it. There's a question, and then you're required to come up with the income statement under the two methods. Then you do reconciliation. So what you also need to understand, if you look at the cost outline, let me see if I can get it. Yes, it is here. If you look at our cost outline in topic number 7, look at what the examiner wants you to know. But they are very funny. In topic number 7.1, you should be able to understand the differences between marginal and absorption costing, which we've done. Comparative income statements, which we are going to prepare, but we've compared the differences and within the comparative income statement components as we do a practical question. Here in the course outline, let's be clear on this. 7.3, you are being told to give us, to do what? To give us arguments for the use of marginal costing. Then arguments for the use of absorption costing. But if you go to, is it April 2023, you'll find that the examiner is telling you to give 4 disadvantages or arguments against marginal costing. When you come to your course outline, it is not there. We only have arguments for the use or the benefits of using marginal costing. But now if you get to the question, they are telling you to give the disadvantages, limitations, or arguments against the use of marginal costing. In some cases, they will tell you, can you outline 4 limitations of marginal costing that may make someone to shift from using marginal costing to using absorption costing? Then you are being given free 8 marks there. You are being told to highlight the limitations of marginal costing that may lead to someone shifting from marginal to absorption costing system. So you can do a research on that. You can look at the limitations. You can look at the arguments against, but within the course outline, this is what is here. But CASNEB normally said some things outside the framework which they have given. So like limitation is not appearing here, but you may find that in your exams, you'll be asked to give at least 4 limitations of marginal costing. So that is it. If you get to the same topic number 7, if you cannot go through these notes, you can also get the other notes here, which I believe are almost related. So you just get to this part here. Just get to that part there, where I will be sharing my screen with you. So if you look at this one also, it is almost the same as what we have there. You are being told to give the differences between marginal and absorption costing. Those are the differences that we have there based on definition, contribution margin, inventory valuation, comparative income statements in marginal, the structure, the components, all these stories are there. Arguments for the use of absorption costing, we have them there. Application of marginal costing, 1, pricing decisions. make or buy decisions, production mix decision, that is topic number 8. Then sales volume analysis, that is break-even point, still number 8. Budgeting and forecasting, short-term decision making, that is for marginal, which we've been able to actually explain. So that is it. You can access these notes or just get back to the platform. Just get back to the platform for you to be able to do your studies. So that is it. That is all about the theory. What is remaining here for us is basically to do a question. So are we okay up to that point? 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 Okay, so having done that, I want us to move very fast. I want us to move very fast to a question. A question. Can you get a 5 minutes break before starting a question? Yes, let's meet at exactly 7. Let's meet at exactly 7. But I will be posting the question and the sitting here. So as you go for the break, please try to locate those particular questions. Try to locate the questions so that we do them very fast and mark the end of this particular topic. So our break starts right away. Great. So if you look at that particular question, it is basically putting what we discussed in theory to the practical application. Are we able now to execute the format so that we come up with the net profit as per marginal and as per absorption? So our question is from topic, from August 2022, question number 4, A and B. It is ATD, sitting. So if you read that particular question, you'll be able to see you are being told that RH Limited manufactures and sells a single product branded Z. Currently, it uses absorption costing to determine profits and inventory values. The budgeted production cost per unit is as follows: direct labor, direct material, fixed production overhead. Now, the cost given there per unit, the direct labor, the cost, so for you to interpret that, you're able to see direct labor, we have 3 hours at shillings 6 per hour. Is it? Now, if you look at the cost that's going to be incurred to produce 1 unit of this product Z, we have 18 shillings. So are you able to give us the total labor hours required? The total labor hours required to produce this particular unit. 3 hours is charged at shillings 6 per hour. Now, of course, they could have given you this 3 hours at shillings 6 per hour, then we have 18 shillings. So somebody will be confusing and checking this one here as the cost per unit. Or material, that is a direct labor cost per hour. Somebody will be confusing and checking this one here. This one here is the cost per hour. This one here is the cost per hour, but not cost per unit. 1 hour is equal to 6 shillings. But this particular product Z requires 3 hours.